This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody. As you know, the annual meeting of the World Economic Forum is underway. Our Bloomberg editorial team, it's on the ground. They're catching up with global leaders from all walks of life. And on that, interviewed at Bloomberg House in Davos by Francine Lacqua in front of a live audience, was the president of the European Central Bank, Christine Lagarde. They talked about a lot of global issues and then turned to the United States. And what Madame Lagarde said, as much as what she didn't say, some would say, spoke volumes.
The U.S. election.
Yeah, let me have some coffee.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. But this is what they should be considering. And of course, we cannot interfere with their choice. It's their choice. And that's the beauty of democracy.
That was the president of the European Central Bank, Christine Lagarde, a little earlier at a Bloomberg House in Davos, being interviewed by Francine Lacqua. Well, U.S. politics, geopolitics overall, certainly top of mind. Just ask our next guest, who's also in Davos and is looking at it from the perspective of global trade. It's all in a new report, Geopolitics and the Geometry of Global Trade. Olivia White is senior partner at McKinsey & Company, also director of the McKinsey Global Institute. Olivia joins us on Zoom from Davos, Switzerland. Good to have you with us this afternoon or evening for you, Olivia. Appreciate you certainly staying up a little later there to spend some time with us. Give us an idea of what the tone of Davos is like this year. What's the conversations that you're having on the ground, and what's sort of the vibe that you're feeling?
Yeah, I would say it's unsettled, but there's a mix of optimism linked to some of the stuff that's going on in the world. I mean, it's difficult to have a conversation here without Gen AI coming up and what that might mean, for example, for productivity. But there's the obvious real uncertainty about what's happening in the world at the country level and then at the geopolitical level. And what does that mean? And linked, of course, to our report.
Well, so let's talk about that report, because you guys have note in it, historically, and I'm quoting from it, historically, value chains have shifted gradually, and recent years are no exception. No economy has gained or lost more than an annualized 2 percentage point share of global exports in any value chain since 1995. Despite increasing tariffs and restrictions in recent years, that has not changed. But since 2017, the geometry of economies' connections has been shifting. Why is that word geometry so important? Play that out for us. Explain it.
You know, if you think about what mattered for trade over the past, call it 25 years, we talked a lot about trade intensity. How much does an economy trade? We talked also, to some degree, about the geographical distance. So just how far does stuff travel? But in this new world, we also have to worry about other quantities. And the other sort of two dimensions of our geometry that we look at are a geopolitical distance. How aligned are countries that are trading with one another? And are countries shifting to closer aligned economies or not? And then also concentration, because concentration can be a measure of risk and supply chain risk, put aside geopolitics.
Well, let's stick with the idea that we're talking about the U.S. here, and that the president of the United States has a lot to do with how a country thinks about trade. And kind of want to put the same question to you that our own Francine Lacqua put to Christine Lagarde a little bit earlier in the day, which is, how should we think about trade under a second Trump administration? What would happen?
Well, let me talk about what's happened from 2017 between 2017 and now, and how the geometry of U.S. trade has shifted. So we are trading across smaller geopolitical distances. So our distance of our geopolitical trade during that period has gone down by 10%. Following the introduction of the tariffs in 2018, our trade with China dropped most, particularly in electronics, but across a whole range of value chains. At the same time, the distance of our trade went down a little bit. So that's a little bit of nearshoring, but not a lot. And that's a bit of shifting to Mexico. Interestingly, that is not predominantly because of shifting from China to Mexico. That's because of shifting transport equipment, autos, from Japan to Mexico, and also some agriculture from ASEAN, Southeast Asia to Mexico. And then the final thing I'll note is, if you talk about de-risking, the diversification of our trade has actually gone up. So less trade with China, more trade with a whole host of other countries.
So is there, a net here as you talk about this? I mean, is it good? Is it bad? I mean, is there a takeaway? And I'm curious, you guys work with a lot of companies, right? Advising and so on and so forth. Olivia, do you guys say that this, geometry of economies, these connections and how they've been shifting, is it good or bad?
Look, big question about where we go in the future and, what would be good, what would be bad. And one thing that we look at is, what about a future world in which we all start trading with people who are geopolitically closer to us? Mm-hmm. So less trade between the U.S. and China, for example, more trade between the U.S. and Europe and other closer aligned economies. What does that look like? And what does it look like instead if we all diversified our trade a bit more? And what we find is that is a decided trade-off at the global level and to some degree at the economy level. So the more you try and trade over the long term with your geopolitically aligned economies, the more concentrated your trade tends to become, and vice versa. So if you want your trade to be more diverse, less concentrated, perhaps less beset by certain kinds of risks, well, you've got to trade with more folks. And that the latter, the diversification scenario, also tends to be better for growth. So, Carol, I'll leave you and the listeners to what's good or bad, what's one really trying for. But if what you're after is a sort of broad resiliency and growth, right, just trading with geopolitical partners or more aligned economies is probably not what you're after.
But this stuff is really fragile, as we're seeing right now in the Red Sea, Olivia. Mm-hmm. And I'm wondering how closely. Well, obviously you're watching it closely, but I'm wondering how much of a risk attacks on ships that are trying to get through the Red Sea, if you're looking at that as something that's temporary or something that's like a permanent shift in the way that companies are thinking about getting goods through that area.
Look, I'll say to some degree, fragile's in the eye of the beholder. When you focus just on the trade part, there's obviously a much broader conversation about what's happening in the Red Sea. But when you think just about trade, the fact of the matter is the system has managed to adjust, sort of be self-healing rather well. And this is true, for example, in the way that trade was diverted after Russia's invasion of Ukraine. It's true even for what were real supply chain blockages during COVID. We managed to ship actually more through the system than ever we had before. So the fact is that the web of trade as we have it today right now actually can accommodate some real shocks and sort of buffer them. But make no mistake, these are all scenarios that people are thinking about. You asked me about what people are thinking about here. They're thinking about these scenarios. And all the companies that are operating across the globe really are thinking through these scenarios that dictate what their trade will look like in the future.
I think it's interesting too when we are in an earnings season that's really just getting underway, and you think about the C-suite at multinationals or global companies and what they've got to think about. Like, this is something based on what you're saying is that they've got to kind of consider this in terms of how they think about who they're dealing with. It's not just countries, but companies certainly, and what they're dealing with. It's just another big issue that they've got to potentially deal with. So appreciate it, Olivia. We know it's later there, but we're really glad it's a timely discussion and glad we could bring it to our audience.
Thanks for skipping a party to hang out with us. I thought Davos was all about the parties,
Are you
Olivia.
Still going?
He's next. Thanks a lot.
Okay, cool.
Yeah.
Good.
Olivia White, Senior Partner at McKinsey & Company, Director of the McKinsey Global Institute, on Zoom from Davos, Switzerland. We do hope she gets a nightcap. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Well, war between Gaza now raging for more than 100 days. The war between Israel and the Palestinian Islamist group Hamas has drawn in Yemen's Houthi rebels who have controlled northwestern Yemen for nearly a decade. Now, like Hamas, the Houthis are hostile to Israel, backed by Iran. The rebels have disrupted traffic in the Red Sea by repeatedly attacking ships there, and they've attempted to strike Israel with missiles and also with drones.
Well, the U.S. and U.K. have launched airstrikes on Houthi targets in Yemen in response to these ship attacks. One more thing we should note, Iran conducted a missile strike on a militant group in Pakistan, sparking a diplomatic crisis between the neighboring countries at a time of rising regional tensions. The bottom line here, Carol, a lot of moving and volatile parts to this very complicated conflict.
Absolutely. So with what you need to know, Mick Mulroy is with us, former Deputy Assistant Secretary of Defense for the Middle East, retired CIA officer, U.S. Marine as well. He's co-founder of Lobo Institute. They advise, they consult, they also teach on current and future conflicts and how to put an end to them and also prevent their recurrence, and how to help those that are affected as a result of it all. He joins us on Zoom from Montana. Also with us, Bloomberg News International Economics and Security Team Editor Larry Liebert. He's on Zoom from Washington, D.C. Mick Mulroy, escalation. Can we use that word to describe what's going on right now?
So great to be with you all again. Yes, I think that's fair. I think we are actually, everybody's talking about a regional conflict, but I think we are seeing a regional conflict right now. The Houthis are intent, as they usually are, at doing anything they can to disrupt the United States, objectives overseas, and they are not going to stop. Although I do think it was the right thing to do to redesignate them, at least under this new designation, as a specifically designated global terrorist organization.
Explain what that does now that they're designated as a specifically designated terrorist organization.
Yeah, so before they were under a different category, a foreign terrorist organization. That did more. It restricted their movements in addition to the financial penalties that come with that. But it was problematic when it came to delivering humanitarian aid into Yemen. And that's why they were delisted. This new designation, the specially designated global terrorist, does give these financial restrictions, but it does allow a carve out so to make sure that all these very needy people in Yemen, about 21 million rely on food aid, can still get that without any interruption.
All right, Larry, let's bring you in. You follow international economics and security here for us at Bloomberg, talking with the administration. What's your intel? As we just heard from Mick, saying we are seeing a regional conflict. Is this a regional conflict, though, that increasingly is pulling in the United States, Europe, and other places in the world that they kind of can't go back on?
Yeah, I think it definitely is a regional conflict. The question is how you define that. It's not an all-out regional war. The lid is on, if just barely, on all sorts of regional tensions. And you see, for instance, in this attack, Iran attacking this group in Pakistan, you see an example of the never-ending conflict between Shiites and Sunnis in the Muslim world, and that includes, in this case, Shiite Iran striking a Sunni group that it considered terrorists and provoking a conflict with Pakistan. And that's just one of the side effects, because all of the groups, all of the interests in the region are seeing this as an opportunity, if nothing else, to become more visible in their roles.
Mick, do you think this Iran attack on this militant group in Pakistan, is this an isolated dispute, or is this something bigger?
So I think Larry is right. There's been an ongoing Shia-Sunni issue for a long time. This is seeing it come to head. We saw the ISIS attack in Iran that killed so many people. And I think a lot of these strikes from Iran are indicative of that. And although this is a regional conflict, as I've already said, it could get worse. The big issue right now is whether there becomes a second front in Israel with Lebanese Hezbollah. They are much more capable than Hamas ever was. That would be a significant increase, escalation, if you will, in this conflict. They could have significant reverberations in the region.
Is that, Mick, what's holding it back from becoming, we talked escalation already, but even something much more on a kind of a World War III kind of level?
Well, it would certainly take this into a hot war that's direct and substantial. The Hezbollah, I don't think, actually wants this conflict, but they also won't pull back from the border with Israel, which is required, I would say, under UN resolutions. And Israel cannot put their 70,000 citizens who they had to pull off that border and put in hotels until they do pull out. So I think, talking to the Israelis recently, I think they view this as inevitable. And that's something the United States does not want to see happen. That's why we put those two one aircraft carrier strike groups in the Eastern Mediterranean. But at the end of the day, it's not up entirely to the United States. If that war kicks off, it could significantly affect the region and really blow this into a large regional conflict.
Larry, come on in. I see you nodding here. Go ahead.
I'm going to say that's absolutely true. Also, the question is, what does Iran decide, and what does Iran really want? They clearly are eager to encourage and arm these various groups, all of which we describe correctly in stories as Iran-backed. But it's not clear that Iran directly wants to get involved or that they want the lid off all of these tensions as opposed to just keeping it bubbling. So that's going to be the big question, isn't it?
Well, Mick, what do you think Iran wants here?
So I think they like the fact that they have caused this turmoil. They support the Houthis, Hamas, Hezbollah, all the militias that are attacking our positions in Syria and Iraq. But Hezbollah, they actually started. So the IRGC, which is kind of like their special operations intel mixed group, the IRG Quds Force specifically, started Hezbollah, and they are substantial. They have a lot of fighters and an incredible amount of weapons, and not just weapons, but precision weapons. So they could target the airport, Ben Gurion, they could target the infrastructure, the cell network, the electrical network, and they can, even though the Iron Dome is a very capable system, they can overwhelm it. They have like 60,000 of these that they can launch almost simultaneously, and there's no system in the world that can handle that.
Mick,
so that is what I think is the biggest concern. Iran is really a key factor in that. I don't think they want a regional war directly, but that is something we'll have to see.
Well, that's what I was going to say. Mick, what holds Iran back from taking this step? Once you cross that threshold, kind of there's no going back.
Right. And I think, there's a saying that Iran has no problem fighting to the last militant in their proxy groups because it's not really consequential to them. They don't have a problem if these militants are dying. Now, these IRGC Quds Force are getting caught because they are out there helping them and we're targeting them. But they don't have a direct attack against them. That could happen. And if that happens, it's not going to be good for Iran. They already have a lot of things going against them. This would be another one. The United States, I don't think, wants to do it, but it would also give potentially Israel a chance to mitigate what we haven't talked about yet was the potential for Iran to get a nuclear weapon.
Larry, I want to end with you, just give you the last word. We have a minute left. Just weigh in on everything that Mick just talked about and also about, my question, which is what's the U.S.'s appetite for actually getting involved in a real war with Iran?
Well, the appetite for the U.S. is very limited. The question is whether they would have no choice if there's direct Iranian involvement. And so it's all on a knife's edge and remains that way.
Like I said, I feel like the global economy and then geopolitics, and not necessarily in that order, is our top stories. It feels like every day.
The two are inextricably bound.
Yeah, exactly. Hey guys, thank you so much. So appreciate it. Mick Mulroy, former Deputy Assistant Secretary of Defense for the Middle East, as we mentioned earlier, also a retired CIA officer and U.S. Marine, co-founder of Lobo Institute. Kind of like what their mission is in terms of, teaching us all about conflicts, current and future, how it affects everybody and how we prevent them going forward. Bloomberg News International Economics and Security Team Editor to Larry Liebert with us, getting us up to date on that situation on Zoom from Washington, D.C.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We got an update today on how U.S. consumers are doing, courtesy of a strong December retail sales report. In fact, they're doing kind of well.
Yeah, opening up
They
their
were in
wallets or
December.
swiping their credit cards or buying now and paying later, however you want to put it.
Not so good.
Data like that continue to temper back expectations of a Fed rate cut sooner rather than later. Fed swaps now show the probability of easing as soon as March, dropping to around 50% compared with 80% on Friday. Carol, also key, what workers at companies are doing when it comes to business travel and corporate card use.
It's another metric, right, that tells us about the health of the overall U.S. economy, or maybe even global economy. Hey, Jennifer Petty knows all about this. She's head of Global Card and Comprehensive Payables over at Bank of America. She joins us on Zoom from Charlotte, North Carolina. Jennifer, nice to have you here on Bloomberg Businessweek. We did get that retail sales number, so we know kind of the U.S. consumer, certainly last 3 months of the year, in December doing okay, but more than okay. What are you guys seeing when it comes to corporate card spending specifically? Because you guys have a great vantage point and window into all of that.
Sure. So we're actually seeing growth, and we've seen growth since the pandemic. There are reports out that said 2024 was going to be the year where we saw spend growth or more travel growth that would really align to what we saw in 2019. We actually saw that in 2020, and then 2022 to 2023, we saw growth at 26% in travel spend. So we think that's going to continue, and we definitely think that that shows, our clients are traveling, they're going to see their clients, they're meeting together, and we think we'll continue to see growth. So similar to what you're reporting.
All right, so you've seen spending on corporate cards and corporate card clients since the pandemic. So help me understand. So 2022, and how did the subsequent years, or 2022 to 2023, how did that compare to the year before? How did it compare to pre-pandemic? I just need a little context and perspective here.
No problem. So in 2022, we actually saw the spend that we saw in 2019. So post-pandemic, 2022, we saw pre-pandemic spend actually come to fruition. So a lot of pent-up demand to actually go out and travel. Because we weren't able to travel for some time. And then from 2022 to 2023, we actually saw 26% growth year to year. So we definitely anticipate that to continue into 2024.
Now, I'm wondering, thinking back on how you anticipated 21, 22, and 23, because what we try to do is understand accuracy of projections here. And if we were talking to you last year at this time, no doubt, Jennifer, we'd be asking you about companies pulling back, fears of a recession, and your expectations there. So how did your expectations last year and the year before, how were they met, exceeded, or not met? Just so we have some context.
Yeah, I think they were exceeded, because we definitely heard the same things that you were just mentioning, and the trends and the pullbacks, et cetera. But we didn't see that. I think some of that was really pushed by wanting to get in front of customers. Some of the industries that we saw growth were higher ed, biopharma, software companies. Some of our larger corporate clients that are around the globe were the ones that we really saw driving that additional spend. But also, we know that many companies are getting together for strategy meetings, et cetera, because many of their workers may work from home. So getting that travel together and getting to client meetings or getting to strategy meetings, we really saw that uptick as well, just based on the different workforces that we saw at home or in the office.
So was it more transactions, or was it just the dollar amount went up? Because that plays into the inflation story, which we all know so well in those years, was really pushing prices or the cost of services much higher.
Right. And it's a little bit of both, right? It was pent-up demand to start to travel, and those meetings definitely happening, but we know that fuel and airplanes increased airline tickets. And so we definitely saw an inflationary impact on the price of those tickets, really driving higher spend. So you're absolutely right.
Okay, so what are, we're hearing a little bit from different data that we're getting. We got that Gusto data a little earlier that we talked about with our TV team that did payroll processing for 300,000 small businesses and saw bonuses were down. Does the tightening of the belt when it comes to wages, is that reflected in how you anticipate spend, or does that have to be looked at completely separate in terms of how businesses are thinking right now of an employment story rather than one about the economy?
So I think it all comes down to the expense that the company is willing to spend, right? So it does play into it, but I definitely think that companies realize that travel, in many cases, in some industries, is still important to sell, to meet with clients, and to really drive meetings that really set the strategy. So I definitely think that helps or plays into that number. A lot of the things, though, that we are also seeing, some of the growth is shifting from consumer cards, right? Many employees maybe were using their consumer cards. There's a lot of best practices being rolled out to say, please use your corporate card. It enables a digital experience. It's much more like consumer experiences today. There are apps available. You can put your card in your mobile wallet. So giving that consumer experience is also growing the travel spend amount because we're seeing our clients are more willing to use corporate cards than consumer cards. And that really makes a better environment, but really drives the spend as well. So back to the earlier point, it's not necessarily more travel, but it's definitely higher cost, and it's putting more spend on a corporate card versus using a consumer card for corporate travel.
Hey, two things. When it comes to travel, are you noticing, though, in that corporate spend on travel that it's less overseas, more domestic, like to keep the costs down? Anything that you're noticing in that might be interesting to our audience?
We definitely see trends where we're seeing more in-country, so domestic travel. But we're definitely seeing the global travel as well. So I think more time will tell. Because I think none of that travel was really happening. And so we're seeing it on both sides, but maybe more time will tell us.
Is there a different way that this money is being spent versus pre-pandemic? Are clients being entertained in a different way? Are people traveling less because they have Zoom meetings so they're able to do sort of different things with that money? How would you characterize that?
One example that I would say is there's a new way of using travel cards, and that is virtual travel solutions that we're able to offer customers. And again, as customers really try to do more with less, as they try to digitize more, they're looking for more ways to put payments on digital means. And if you think about utilizing corporate travel cards, they're always used for employees, but there was never that comfort in maybe providing it to a contractor or providing it to someone that you're recruiting, that you're wanting to travel in and talk to them about a new opportunity. And virtual travel solutions enables even more opportunity to use a travel card, but it's virtual.
Right.
It's used in a wallet only, and it's very defined on what it can be used for. So I think we're really seeing corporates challenge us to provide them ways that they can use cards in a different way.
Hey, Jennifer, just got 30 seconds left here. In terms of new accounts being opened, what can you tell us about that and what it tells us about the kind of economic outlook or economic environment? And just got about 20, 25 seconds. Forgive me.
Sure. So different than a consumer, when we're looking at new clients and new card holders, a little bit different, but we're definitely seeing travel spend grow, new accounts being opened, and new ways of using digital accounts for travel.
All right. Okay, so it sounds like more new accounts versus net closings, correct?
Correct.
All right, good stuff. Hey, Jennifer, thank you. Jennifer Petty, she's head of Global Card and Comprehensive Payables at Bank of America.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just under 18 minutes left in today's trading session. We've talked a little bit about what we've really seen. What's been significant is the move up in yields once again. That 10-year, Charlie just breaking down the markets, but just a reminder, 10-year at 410 and that 2-year note 434. Of course, more sensitive to expectations of what the Fed may or may not do.
Yeah, that front end of the curve, seeing some...
Love it when you do that.
You love that. I got to be honest. Walking in here 3 years ago, I knew nothing about the yield curve. And Carol Massar has taught me everything. So.
I hope I haven't taught you everything because we have much more people on this. But it's great to watch the bond market. Like, we talk so much about the equity side of things, but what goes on in fixed income, whether it's corporate debt, can tell you so much about the health of certainly, corporations at large specifically or more broadly in our economy.
Well, on that note, we're pleased to welcome in JoAnne Bianco, investment partner and client portfolio manager at BondBloxx. It's an ETF issuer focusing on U.S. fixed income options, government corporates, and the like. Full transparency, the funds track Bloomberg indices. JoAnne joins us on Zoom from Chicago. We should note BondBloxx has $2.6 billion in assets under management, growing quite a bit over the last couple of years.
Yeah, and let's start there. JoAnne, first of all, great to have you here with Tim and myself and here on Bloomberg across our platforms. You guys, though, can we talk about assets? From what I understand in reading in, you guys have more than doubled, I believe, assets in the past year. Do I have that right?
Yes, you have that right. We've launched 20 ETFs and more to come. And we've actually seen a lot of growth in terms of our assets under management. Yes, we have more than doubled our assets in the past year and a half.
Well, so let's go with that. Recent fund flows or where that money is coming in organically in terms of maybe some of the existing investors or new money. Where is it going? Talk to us about fund flows, because I can feel like it tells us so much in terms of the investor psyche.
We're definitely seeing fund flows across the curve in our treasury products. We have 8 products across the curve, starting with a 6-month target duration ETF out to a 20-year target duration ETF. And so we're seeing, we had a lot of demand for our shortest products last year, but we're seeing continued demand in the short products, but people also going out the curve a bit.
How much are they going out? 3-year, 5-year?
We're seeing moves across the curve. We're seeing more of the flows nearer term, but there are some very long investors too. We're also seeing a lot of flows into our high yield funds. We have credit rating category funds rated BB, single B, and triple C. And actually, we've been really very happy to see that we're getting more flows into our triple C rated product within the last few months. Okay,
so that's where the flows are. That's where the money's going. What are your own expectations when it comes to the yield curve? Where do you think yields peak? Let's say 10-year. Where do you think the 10-year? Do you think the 10-year has peaked when it went to 5 just a couple months ago?
I do think that's the peak. I'm not to say that we don't think that rates could go back up from here, but I would be surprised to see a 10-year greater than 5% again in this cycle.
And that fits in with what you're thinking about for the U.S. Central Bank, the Federal Reserve, in terms of, we've seen it, the story. Everybody was so aggressive in what they thought the Fed was going to do late last year. And then, of course, there's been wait a minute. And that started late last year, too. At the end of last year, people were kind of dialing back those bets. And we continue to see that to some extent. What is your expectations for what the Fed does, the U.S. Central Bank?
Yeah, well, we don't think that, we've never been as optimistic as the market has been, especially recently. When the Fed is telegraphing 3 rate cuts for this year, we don't see a reason to telegraph more than that. So, we're not surprised that people are starting to dial back their bets in terms of recent days.
Are you thinking that, what's changed for you? I know what's changed in terms of the data, but it did seem like investors really got ahead of themselves when, after the last meeting, the dot plot essentially showed 3 cuts this year. Investors were pricing in 6 cuts. Between that meeting and now, what changed?
Not a lot changed. Maybe it's just, the market did get ahead of itself and was overly optimistic. And, they've been overly optimistic for about a year and a half now.
So let's talk about high yield, right? That was your top pick in 2023, continues to be so. Is it because of what we'll get from the Fed or at least some easing? What's your expectations or thinking around that?
It's primarily due to the higher income generation that you can get from high yield. Yields are still elevated, and we also have still very supportive fundamentals. We're entering 2024 from a strong fundamental backdrop for high yield corporations, even the lowest quality ones. So that's different this time around. It's not to say that we couldn't see some softness from here, but we're just at this point, we think it's very supportive of high yield earning an attractive return this year.
Is it industry specific? And I'm just, because I bring up our concerns about certainly commercial real estate, office real estate in particular. So I'm just curious, is it, when you look at high yield, industry specific?
Well, I like to look at industries and also at the credit rating category breakdown. So we have ETFs that are rated BB, single B, and triple C. And so investors can either dial up or dial down their risk based upon their view of the outlook for economic conditions in the coming year. So if they're more worried about more softness in the economy, then they could invest in BB corporates. And if they're less worried, then they can invest in single Bs or triple Cs.
Any new ETFs for 2024?
We're going to have some new ETFs for 2024. We're going to have some ETFs in the investment grade side. We're very excited about that. Stay tuned.
Is there a fixed income spot Bitcoin ETF play for you guys?
I don't know if that's like that.
I'm kidding.
Those really run counter to one another. Fixed income and spot Bitcoin.
Really?
Nothing with Bitcoin should have income.
Is there a high yield component to it? I don't know.
Word, right?
Looking forward to seeing what you guys bring to market, but really fun to hear also in terms of where the investors are plowing money into. So appreciate it. JoAnne Bianco, investment partner and client portfolio manager at BondBloxx. As we said, an ETF issuer focusing on U.S. fixed income options, a variety there, about $2.6 billion in assets under management. She was there on Zoom from Chicago.
S&P down 0.7, NASDAQ down about 0.7, and the Dow down 0.3. This is Bloomberg
Radio.
Businessweek.
Jinx.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.